We're living in unprecedented times. Our world is changing faster than we can imagine. As a civilization, we are being struck with crisis after crisis. We are constantly bombarded with the news of the pandemic, high inflation, bubbles, fraud, and fragile international relations, and now war as well. Volatility has become the norm, and the common man is at the center of this storm. Fear and uncertainty have engulfed investors from across the globe, severely compromising asset prices. Businesses are standing on loose soil, because of which every single employment takes a beating. But with all due respect and with my heart going out to the people who suffer today, I'd say that there is light at the end of the tunnel and that we as a people will endure and prevail. Tough times will pass. Often in life it is the simplest ideas that mark the beginning of a man's success story. The ability to simplify means to eliminate the unnecessary so that the necessary can speak. Today we're here to talk about someone who believes that knowing one thing perfectly is a million times better than knowing bits and pieces of many. He's somebody whose journeys, both personal and professional, are testimonies to the fact that it takes a belief system to weather any challenge that life throws at you. A belief system that anchors you every time the silly human brain tries to overcomplicate the myriad predicaments that you will find yourself in over the course of life. One which stands the test of time and is unclouded by the noise of the world. Really quickly though, today's video is sponsored by The Daily Upside, a totally free, high-quality business and finance newsletter. Visit the link in the description to learn more. Now today, of course, we're talking about none other than the pioneer himself, Peter Lynch. As inflation soars, we will discuss one of the best money managers Wall Street has ever known. Lynch headed Fidelity Magellan, the nation's largest mutual fund and certainly one of the most successful. In 13 years, he drove Magellan to a 2,800% gain at an almost 30% annual rate. To put that into perspective, when he took the reins, he inherited a fund of $20 million and grew that to $14 billion in assets under management during his tenure. Currently, he is still sitting on the board of trustees for the Delta Group and is also the vice chairman of Fidelity Management. Lately, an overly generous monetary policy and unrealistic valuations have put the market into overdrive. A scenario that is similar to the 90s and the tech bubble that we saw then. Here's an excerpt of Lynch's commentary from back then.
The market since World War II has sold between 10 times earnings and 20 times earnings. If you look at the Dow Jones or the S&P 500, if you add up all the companies and take the earnings, you say there's a relationship. And it follows. McDonald's earnings have been terrific the last 30 years, and the stock's been terrific. There's a direct relationship. So the earnings of the S&P 500 have been between this range of 10 and 20. We were just about to go over the 20, which is the high end of the PE range. There wasn't a lot of room left on the PE
of 20
side.
is at the top of how high it should ever be.
Right. It's been over there only a few times ever over 20. And that's when usually inflation's about zero. In the early 60s, when inflation was about zero, we got a little bit over 20. Now we have a very low inflation rate. So if you usually have subtracted inflation from 20, you've had the PE of the market. That's been a pretty good ratio. When inflation was 12%, you remember in the early 80s, we had an 8 or 9 PE of the market.
So Dr. Lynch says all of this has been good for us?
Well, I'm telling you, it would not have been helpful.
It's like a purgative or something.
I never thought I'd ever wish for the market to not go up dramatically. But let's argue the market went to 16,000 tomorrow. Yeah. Basically, there's earnings behind companies.
Okay, but I'm not arguing that. I know that's true. And
that would be crazy.
And stock market price ought to be dictated by earnings. And earnings.
The beauty of economic happenings is that we can learn a lot in retrospect. Despite the pace of growth across global economies, the market's peaks and troughs are seldom unique and can be reduced to very simple observations to learn from.
Well, we had a huge run. I mean, the market was 4,000 just 2.5 years ago. Yeah. And it ran up to 8,300 in August. And, like any big rally, sometimes it backs off. I mean, it's healthy. In fact, I'd rather have gone down 1,000 points than gone to 12,000. If you look at Japan, Japan went from 5,000 to 15,000 on their Dow. And it was fairly priced at 15,000 on earnings and everything else. Then it went to 40,000. And that caused 7 years of inflated real estate, people overspending. And basically, they've been in a recession for 5 or 6 years because their market went up too high. I mean, if the market goes up too high, if the market goes too high, you're discounting earnings 7, 8, 10 years out.
So everything is overpriced.
Yeah, and that doesn't...
Around 1990, Japan's market index started at 5,000 and quickly jumped to 15,000. Shortly after, the market shot up to a whopping 40,000 points. As a result, real estate prices and other asset prices skyrocketed. The crowds overspent, spiraled, and eventually pushed Japan into a recession that lasted for 5 or 6 years. This simply occurred because the market was overpriced and the socioeconomic climate became unstable. Now, does that sound familiar? Well, it should, because as of March 2022, that is exactly what is transpiring. The S&P 500 stood at 3,300 points right before the pandemic struck in 2020, a couple of years ago. Within a few weeks, the pandemic hit the American shores, and overnight our society found itself changed. Businesses and livelihoods went under, hospitals found themselves overwhelmed and unprepared, and the market sank 30% from its peak. Now, nothing much has changed since. Sure, some businesses and societies are beginning to recover, but the bruises of our recent past are still fresh. Ironically, the depression showed everywhere except in the stock market, where indexes rallied 30% and almost doubled from the lowest point when the pandemic broke out. In 2021, the Federal Reserve forecasted that consumer prices would be about 1.8% higher than the prior year, below even its 2% annual inflation target. But things don't always play out according to plan. The Labor Department reported that consumer prices jumped 7% in December compared to that previous year. This is the hottest year-over-year inflation since June of 1982. The highest in 40 years. The Fed Chair Jerome Powell had characterized higher consumer prices as merely a transitory problem. He stated that the inflation was a result of temporary shortages of supplies, shipping delays, and people rejoining the workforce as the economy rebounded from the pandemic paralysis. No one predicted the economy to bounce back so quickly, especially the Fed, leaving them completely off guard. It's important to understand why inflation is an invisible menace to society, so to that end, let's quickly recap what put us in that spot in the first place. But really quickly, before I go any further, let me quickly tell you about today's video sponsor, The Daily Upside. Now, if you are struggling to find crisp, unbiased financial news, The Daily Upside may be the solution to your problem. The Daily Upside is a free business and investing email newsletter that over 280,000 people subscribe to, myself included. It was founded by a team of financial professionals with the intention of providing clarity and context on the events shaping the world of business. Every weekday, they deliver a morning brief, followed by more detailed stories that are shaping the business world. It's become something that I read every morning as an informative, witty, and not dumbed down. They go beyond the headlines and provide real analysis on the most important news of the day. Recently, they had a piece discussing the immediate impact of Russian exposure in the European market, in which 22 companies have wiped $100 billion of value off their stocks. Whether you are a financial professional or just looking to get a jump start on the news moving the markets, The Daily Upside is the perfect solution. It's totally free to sign up, and they send you one information-filled email every morning. As someone who looks to stay on top of the news to create videos like this one, I can't recommend it enough, so make sure to sign up below using the link in the description. Now, from the onset of the pandemic, a record-breaking 22 million jobs were cut, and the country's output sank by a third. As people battled sickness, economies were at a complete standstill. Businesses cut investment, restocking was postponed, and we entered a brutal recession, the likes of which we've never seen before. Fundamentally, this recession should have gone on for much longer than it did, but the government, which is answerable to the American public, rose to the challenge that the pandemic gave us. The Federal Reserve began printing money and slashing interest rates. This was the first time the Fed had cut interest rates by more than 0.25% since the Great Recession. Through quantitative easing, the Federal Reserve purchased $120 billion worth of assets every month. To top it off, the US government even signed the single largest relief package, which included a one-time direct cash payment of $1,200 for every American. As the stimulus brought the momentum back into the economy, businesses had to rush to meet demand. They could not buy enough supplies to meet consumer orders or hire fast enough to fill job openings. A record 10.6 million job openings were posted in November 2021, for example. As businesses bounced back, ports and freight yards could not handle the traffic, global supply chains got entangled, costs rose, and obviously, companies found a way to deal with it, passing over the costs to their customers, which trickled down to every segment of the entire economy. We know that the Federal Reserve targets inflation at 2%, an ideal figure for a healthy and sustainable economy. But through the drastic actions of the government and global events, we have now reached an inflation rate of 7.5%, pushing 8%. Suffice to say, the US has entered the danger zone, and inflation is not going back to normal levels anytime soon. The US government and the Fed are in limbo. On one hand, it needs to tackle monstrous CPI figures, and on the other hand, it needs to heal the wounds of the pandemic. Too much action on monetary policy and you put the entire country in a knee-deep recession that will take years to recover from. Too little and inflation will cancerously erode away the wealth of the masses, depleting household purchasing power and reducing consumer spending, causing permanent damage. The Federal Reserve has to walk a fine line between these two evils. From the looks of it, Powell has made his intentions clear. This year, the Fed will be increasing interest rates. They will most certainly pour water on the overheated economic engine. A natural outcome of raising interest rates is that stocks look less attractive in comparison to Treasury bonds whose return is guaranteed by the US government. Investors therefore start to pull out of their money from volatile stock markets and park it in bonds. When rates are hiked and liquidity vanishes from the system, it will push investors against the wall. Investors who have become comfortable with the bull runs from the past 2 years. Fear will engulf these investors who are now worried that the tanking stock market will wipe away all their previous gains. One clear indication of the current stress levels is reflected in the price to earnings chart of the S&P 500. Fundamentally, there is a direct relationship between the earnings of a company and its stock price. For almost 90 years, the PE ratio for the S&P 500 has lingered in the range of 10 to 20, which is fair. Since 2014 though, the S&P's PE ratio has been on the rise. Average PEs have increased tremendously and this ratio now sits at 35. Now this is an alarming situation because there have only been a handful of times where the PE ratio has overshot its fair range. High PEs indicate an overbought market. Whenever this ratio has been very high, a sharp correction in the market has followed. This has only really happened 3 times in the history of the United States. In 1929, in 1999 and 2009. The worry is that we might be in the same situation today. High PEs indicate that investors have higher expectations of future earnings growth and performance because of which they are willing to pay more for those stocks. To sum it up, the market has been hot for too long. International waters are rough and a correction is due. It's now time to learn from the folks who've experienced life a little bit more than us. So here's what Peter Lynch has to say.
Was the decline yesterday, in a sense, it let off some of this overvaluation. The market was even overvalued at where it was, and by letting it off, then we got back to what was reasonable.
Well, yeah, I would say fairly priced. Maybe for the larger companies, they're now okay. There might be some small companies. I mean, we've had 3,000 companies come public the last 4 years. That's 2 a business day. Yeah. Some of those companies have gone down dramatically, and that's sort of a research zone that average people in the stock shop, that's where we can find. Some people know a lot about this. 10,000 public companies. A lot of them are very attractive. No one's following them. I mean, there's lots of people following IBM.
Well, that's
lots
how you
of
got rich following companies that nobody else followed.
Right. I'd like to go to see companies with unions or companies in trouble or companies that no one looks at.
Hotels that had nice beds.
And, well, yeah, and you have to look at a lot of them. You
or
look at
pantyhose your wife wore. I remember this story.
Oh, okay, you got Pier 1 Imports. My wife found that one too. But you have to look at 20 to find one. It's just you don't go to the mall and find the stock. I mean, you have to say, my God, this sounds like it's good. And then you have to do some steps. You have to do an organized method. People are careful when they buy a toaster. They're careful when they buy a seat. They do some research.
But they don't do it with stock. They call up the broker or they see somebody at lunch and they say, man, I got this hot stock.
Yeah.
And you're
trying to do is say, of all these public companies out there, here's the company I really like. The fundamentals are terrific. Their earnings are doing well. Their competitors are doing poorly. I think this company's doing terrific. And all of a sudden, the stock might have gone from 40 to 30 because of this decline. That would say, wow, here's a chance to buy it. So you're trying to say some companies might have been overpriced at 60 and all they did was go to 50 and say, big deal. So you're trying to find companies you liked anyway. Right now you liked them, and now they've had a haircut. That's what you would do. Not a stock that went from overpriced to fairly priced. Something that was fairly priced at the start of this exercise, and then had a very, a 5 for 4 sale.
Despite the amazing market rally that we experienced last year, some estimates report that around 100,000 businesses shut shop permanently. White-collared executives sitting high up in the skyscrapers of Wall Street just don't know what's happening below. Maybe they're just delusional, but in all likelihood, they're actually turning a blind eye simply because it's convenient. Even with the S&P 500, if you look closely, you'll notice that the index is being dominated by a handful of really high-performing companies like Apple, Amazon, and Microsoft. These companies hold almost a third of the market cap of the index, and yet there are over 490 companies which hold the other 70%. It comes as no surprise then that these 10 technology giants have been driving the bull run for a long time, and even the rally of the last 2 years has predominantly been led by them. On the contrary then, Lynch suggests that there is great value to be found in other fundamentally strong stocks. In an overvalued market, the chances of finding a stock valued at fair value In an overvalued market, the chances of finding a stock at fair value lie in the remaining 70% of the S&P 500. Lynch goes on to state that most retail investors track the same basket of goods that everyone else tracks, a strategy with limited upside and likelihood to lose money in times of correction, as these stocks are most likely to get discounted the moment somebody pricks the bubble. According to Lynch, some of these companies might be great, but they are trading at unreasonable PEs, which are in the hundreds of multiples. These companies are also those which speculators are most aware of and have all the market hype behind them. According to Lynch, one of the biggest mistakes made by retail investors is running behind stocks that are trending purely because of the hype created around them. These stocks trade at unreasonable fundamental values and are the first to burn your wealth. Tesla, for example, trades at 164 times their earnings. US Foods trades at 250 times their earnings. Honestly, these valuations can entice anyone, but in reality, they don't make sense at all, and most of the time, it's all smoke and mirrors. As I mentioned before, higher ratios means higher performance expectations. The underlying asset of a stock is the business and the operations of that company, a characteristic that is bound to have its ups and downs. So if fundamentals just keep rising without a cause, the books of these companies are explicitly yelling caution and need to be analyzed carefully. Lynch is an advocate of passive investing. He says that you should be aiming to be double or even triple your money if your bet is right and wait long enough. However, should you go wrong, you should be ready to witness a 30 to 40% downside as well. Passive investment is a strategy derived from the solid fundamentals of a stock. Lynch encourages methods like analyzing a company's DCF. This widely accepted method treats dividends and cash flows using a growth rate and required rate of return, which is then used to establish the intrinsic value of the company's share price. If the current market price of a stock trades below the intrinsic value, it's deemed undervalued and vice versa.
If you had been managing the Magellan Fund this morning,
yes,
you would have been buying like crazy?
I would have been researching like crazy.
The ideals of investing in Lynch's style are deeply rooted in independent research. Conducting your due diligence takes you a long way, especially during downturns. When investors have access to too many undervalued stocks, they ought to create their watch list and know each one of them in and out. As Lynch says, funnily enough, people do tons of research before buying a toaster or a TV, or even before choosing what to eat, but tend to buy stocks the first time they hear about them. They hear the next guy boast about his recent hot stock purchase and they blow up $5,000. Lynch stresses about the folks who treat the stock market like a get-rich-quick scheme. He advises you to go the extra mile before investing your hard-earned cash. It is imperative to go through a series of steps to determine the asset's true value. The old school ways aren't always obsolete, and as Peter and Buffett would tell you, you have to know the company like the back of your hand, enough to be able to give a business lecture on their inner workings. Another simple piece of advice that Lynch offers is to invest in companies that you have domain knowledge of. He says, what if you worked in the restaurant over the past couple of years? Then we assume you would have seen Taco Bell or you would have seen Pizza Hut and you would have known and seen Chili's was going to do well too. You would have been well aware that these companies are doing well in that certain industry, so you go ahead and buy those stocks rather than going for biotech companies which you know nothing about. Play into your strengths and familiarity, reduces your chances of uncertainty, and it doesn't ruin your night's sleep. We can observe a similar investing philosophy with other renowned investors across the world too. Vice President of Berkshire Hathaway, Charlie Munger, once stated, "I think about things where I have an advantage over other people. I don't play in a game where other people are wise and I am stupid. I look for a place where I am wise and they are stupid. You have to know the edge of your competency. I am very good at knowing when I can't handle something." The world has enough charlatans and financial gurus who keep propping stocks up as the next best investment. Wisdom, instead, lies in sticking to our circle of competence. Noise in the markets will always persist, but to gain financial independence and sustainable returns, following Lynch's simple ideas is all you need to have a high probability of your financial goals bearing fruit. Most successful investors in the world, including Peter Lynch, follow one mantra to the T: invest for the long haul and be patient. In my opinion, this has to be the cornerstone advice for investing, and it is easier said than done. Don't be concerned about what the market will do next week, next month, or even next year. Instead, consider what this company will look like in 5 years. And if you can do that, short-term market fluctuations don't matter and you don't have to worry about them. Lynch states something very interesting. Folks who are focused on long-term returns get excited when markets correct because this allows them to add quality companies at low prices, which helps bring down the average buying price of the portfolio. The entire mindset change of investing switches from fear to optimism. You know corporate profits will be much higher in 10 years, much higher in 20 years, and that's what you have to rely on. So we rely on the fact that businesses will continue to improve, at least in the long term. Perhaps a situation like a lockdown comes again, where businesses get crippled for a year or two, but it doesn't matter because we look for those companies who we believe will outperform 5 or 10 or even 20 years into the future.
Shop we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favorable ratio. We say if I'm right, the stock's not going to go up. It's already discounting terrific things. If discounting terrific things are already in the stock, I don't want to know.
Okay, so this morning you get up and you go in and you look at those companies that fit
that you know something about. You have to have an edge. I mean, let's say the cement industry goes from crummy to semi-crummy to fairly good. Yeah. The stocks are going north. Right. You're going to make money. That's the industry you know. What if you know the publishing industry? Some people have an edge. You work. I mean, what if you last 30 years you worked in the restaurant industry? You would have seen Taco Bell. Right. You would have seen Sbarro's. Right. You would have seen Pizza Hut. You would have seen Chili's. You would have seen these companies doing very well. You should have bought those instead of trying to buy biotechnology stocks you know nothing about. I mean, I know nothing about local area networking. A lot of people are buying this Cisco. They're buying the equipment, saying, we're going to route together all these peripherals and put together the servers.
Well, but that's not a bad buy because they own a huge percentage of their market.
No, but they're saying only a few people had that. I said, my God, if it works for us, other people try it, then colleges will try it, high schools will try it, then they'll go overseas. They knew they were early in the ball game. Right. And they should have been buying that company instead of out buying something they don't know anything about, some oil drilling company. I mean, people have this tendency to always buy something they don't. All you need is a few, Charlie, all you need is a few good stocks a decade.
But this is your song. This has been your song for a long time. Only buy what you know.
No, but people are waking up in the morning and say, there's 5,000 companies out there. Which one should I buy? The average person ought to be able to follow 4 or 5 companies. They ought to be able to lecture on them. They understand the companies. And this forces you. This tool says to you, write down.
I cannot stress enough about the perks of holding long term. It's important to realize that we live in an interconnected world. The cause and effect relationship between asset prices and what's in the news is very strong, and the only moat one can build is to develop a disciplined investment pattern. A clear distinction should be made between how much cash in hand is required to live your life and how much you should be saving and investing. Lynch goes on to say that if you are investing money that you require in the short term, then you're a fool. If you are investing money that you'll need to pay rent, money that you'll need for your children's tuition, or money that you'll need for the upcoming wedding, then you're a bad investor. Because fundamentally, the market may fall in the short term. Who would have thought that out of all things, a ship getting stuck in the Suez Canal would paralyze the entire world's supply chain? Or that in a lockdown world, the usage of devices would shoot up, pushing the demand for semiconductors? The subsequent supply crunch also meant that semiconductors for other industries like auto manufacturing would take a hit. This would then cause delays in car production, which would dramatically impact operations. The butterfly effect has never been more apparent. Small events on one side of the world can cause turmoil to the rest of the world too. We don't know when the markets will crash, and if it does go down in the short term, your portfolio may bleed. But despite that, remember what has worked for you. Stick to the basics and your assets will most likely revert to their mean. Lynch rightly says, there is always something to worry about. In the stock market, the most important organ is the stomach, it's not the brain. If you can add 8 and 8 and get reasonably close to 16, then that's the only maths you actually need. All in all, Lynch's investment strategy during inflation, high interest rate volatility, or an economic meltdown revolves around extremely simple formulas which are practical and replicable. Due to easy access to quick investing opportunities in debt, equity, and crypto through the evolution of technology, it's very easy to lose sight of the big picture. When mistakes are made and portfolios take a beating, judgments tend to get clouded. Regardless, at the end of the day, it's the act of investing. You win some, you lose some. I believe it's always helpful to take it with a pinch of salt, learn from the stalwarts, and live to see another day. So there you have it. These are Peter Lynch's steps to winning in the stock market. Step 1 is to ensure that you're looking at fairly valued businesses that have the potential to be undervalued. Step 2 is to find the businesses you are familiar with and are within your circle of competence. And lastly, keep an eye on the long term and look for solid businesses with low debt and high cash flows. I'm no financial advisor, and this isn't financial advice, but I'm certain that a peek into some of the best brains in the world will serve as a great starting point to avoid investment blunders. I hope you reflect, assess, and then perhaps resonate with Lynch's methodologies before you act on your portfolio. This channel will always strive to scoop gems of wisdom from the stalwarts to help our patrons navigate through our big bad markets. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. And I want to give the Daily Upside one more thank you for partnering with us on this video. If you haven't subscribed already, then click the link in the bio to receive their weekday and weekend edition absolutely free. There's also a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use that. Thank you for all the support. Thanks for watching. Stay stoic. Until next time.